Good morning, Size Traders. How's it going? This is Amos here with Gary, the head trader at SizeTrader. Gary, thanks for being with us today. Just a couple of quick questions. Inauguration was this past Friday. There was a lot of talk during the campaign about some major reform under Donald Trump's campaign. We have a major infrastructure bill that he wanted to pass, lower corporate taxes, repatriation and renegotiation of trade deals with Canada, Mexico, and China. And also, there was talk of a healthcare overhaul. My first question is, what's the priority here for the markets? And secondly, we also talked a lot about earnings per share and how they're historically high. And even though we're in a holding pattern at this point, we see here that the market's very priced very high, and it's the highest it's ever been. And one could make the argument that definitely some of these bills that he's going to pass are going to be a positive for the market. But still, the question is how does Donald Trump's presidency play out in your opinion? What are we looking at long term here? 6 months, one year down the line.
Hey Amos, hey Size Traders. Yeah, so you talked about a lot of really important things and basically the entire agenda of the new incoming president. Um, yeah, I mean he's made it pretty clear that his agenda. I think the markets are optimistic that he's going to tackle infrastructure and reform taxes pretty quickly. But I think he's made it pretty clear that his agenda is repealing and replacing Obamacare, which I think the Senate he passed already a bill to do that. I think secondarily his next agenda is to stop losing jobs, what he calls make America great again, bringing jobs back to America.
Yeah, but I
By
mean, let's say he does that and he brings back 500 jobs here, 1,000 jobs there, 500 here. How does that really affect nationally on a national scale the marketplace for America?
Well, in my opinion, I mean you have a lot of people who have different opinions on this. A lot of economists differ. I've been pretty right, I think, on my calls. I don't want to say I'm always right, but I'm confident with the way I feel. I think this is going to be a net positive for America. I think you're going to see a lot of instability around the world, it's particularly Mexico, potentially China. These are countries that have really benefited in the last 10, 15, 20 years in a very strong way by having American jobs being sent overseas. China has become the second largest economy, partly because you have big corporations from the US and Europe and all around the world bringing the manufacturing base into China. China is a communist country, and their priority is employment. Employment keeps China stable. I mean, they've mentioned it in the past. They don't want to try to hide it. Their promise to their people is we're going to take away certain rights from you, but we're going to guarantee you a living wage and we're going to guarantee you work. And I think that's the biggest problem that China has is it needs to keep people at work because that's what people were willing to give a lot of their freedoms to live in a communist socialist country was based on the concept that no matter what, we'll have a job and we'll live all right.
So
We
just
might,
de facto by hurting China in some sort of trade deal, America already benefits.
well, I wouldn't say that. I wouldn't say China's pay. Actually, I would quite say the opposite in this scenario is that if China, the second largest economy and probably one of the pillars of growth in the world right now, uh, goes into a recession or some type of crisis, that would affect U.S. companies negatively. Also, if the U.S. does put on some type of import tax or trade tax, China will probably do something similar or even be more harsh because they have a lot more control over their corporations and people since it is a socialist communist economy. Now, saying all of that, that's the negative sides. The positive is Apple is not going to stop building iPhones because they need to move their worker base from China to America. Uh, Corporations are not going to stop creating stuff because they have to increase wages by $10 an hour. They might look for innovations like robotics and so on, which is actually positive for the U.S. economy. That's what makes the U.S. economy always grow, is that we're the leader in innovation, something that we've kind of stalled in a lot of ways. We innovated with the car, we innovated with even the internet and so on. A lot of the innovations in the 20th century was based on America. And if you look at it, America's leading the world in a lot of innovations today, including electric cars with Tesla, You have Facebook with social media really changing the world of marketing and putting it upside down from traditional marketing. But the problem is that you need innovation. You need a problem based on cost to spur innovation. If innovation doesn't spur itself, uh, oil prices dropped because let's take oil for an example, perfect example. Since the middle of 1980s until the late 90s, early 2000s, oil was at a very low price. This stopped any innovation by companies trying to figure out how to get oil out of the ground cheaply. There just wasn't money in it. Big conglomerates like Exxon and Chevron didn't put money into research and development because they weren't making enough. And when oil was at $19 a barrel. Now, fast forward 5 years out, oil spikes, partly due because demand increases from China, partly due because the dollar falls, partly due because there's some supply disruptions, and oil prices spiked to 50, eventually on its way to 100, with a small blip up to 150. This allows companies such as Chevron, Exxon, and other companies to invest now in research and development. Companies are trying to figure out how to get this oil that's really expensive at $100 a barrel, and it makes sense to spend $2 billion figuring out how to get more out of it. This pretty much spurs on shale or horizontal drilling, which now increases production in the US, takes us up to 10 million barrels per day, and crashes world prices to a lower level. So now innovation slows down, as you heard, in the last year, if you listen to any of these quarterly earnings, research and development is down, spending on infrastructure is down. There's nobody looking to do it. I mean, before they were talking about drilling in the Arctic when prices were around $100 because the idea was that eventually prices would get to 150 to 200, and we needed the technology to be able to go to Arctic and get oil out cheaply or cheaper than 150 or $200 a barrel. Once oil prices dropped to 40, $50, every single company paused on the Arctic drilling research and development. So basically, that's an example of when prices go up, companies spend on innovation, innovators innovate. That's one of America's great strengths. A lot of people believe that they'll innovate in robotics because robots could displace regular manufacturing jobs and be cheaper than paying a wage of $15 an hour, $20 an hour, plus certain benefits. So it becomes cheaper. So America now will innovate in robotics if that happens. That'll create jobs in robotics. That'll create an industry in robotics. Yes, it will kill the manufacturing worker, but will create better jobs. And that's always been the mantra of the US. Yes, you have a little bit of pain, but we switch from one to one pretty quickly. I mean, internet was supposed to take out a lot of jobs, but now we see the internet actually created a lot of jobs and a lot of wealth uh, on the way to killing a lot of the or lowering jobs. Now you have, you have big retail stores closing down because now people buy online, but you have tons more programmers, tons more app developers, and so on that probably make a better living than they did before. The question comes, and this is the way that I see it, is we all feel and agree that American wages need to go up. As American wages go up, those people will consume more. There's a lot of different ways that economists argue how to get that done. The first way was inject tons of capital into the markets by quantitative easing by the Federal Reserve, basically printing money or creating reserves, like they like to say. And they were hoping that would trickle down to corporations, which would trickle down to the consumer, which would make the consumer consume more, which would push up the growth rate, which would make companies hire more and make more money, and so on and so on. That obviously didn't work. Uh, Banks hoarded that money. Banks would only lend to the top echelon. The top echelon would invest in real estate, stock markets, pushing certain asset classes up. People who benefit from those asset classes are typically in the top 10 percentile of the world or top 1 percentile of the world, top 10 percentile of America. So the rich got richer, the poor and middle class got poorer. That created inequality. So now we're talking about inequality. I don't believe the Federal Reserve thinks quantitative easing is a good tool. It's an emergency tool in their toolbox, I believe. So now, how else could we raise minimum wage to increase consumption? One of the ways is by bringing jobs back. So as you bring jobs back, so if Apple has to bring back all of the manufacturing jobs to build the iPhone, they bring back 30,000, 100,000 jobs. I don't know what the number actually is. Now, all of a sudden, as companies do that at the same time, and unemployment being at 4.7%, you can argue that the real unemployment is higher. People will come back into the workforce, unemployment rate will fall, wages, you'll see pressure on wages, right? So one company like Apple will be willing to pay their manufacturing workers a couple of dollars more because they need to get these iPhones done because they make $200-300 an iPhone, and even if it costs them an extra dollar or extra 10 cents, 20 cents, I don't know how many iPhones they can do per hour, but I'm sure it's more than one. So even if it pushes up their price per phone by a dollar, but on the other hand, they're saving $200 because they're meeting the demand, it makes sense. So basically, Apple's earnings might go down because it costs them a dollar more to build the phone, but they're still making 150, 200, $250 per phone, depending on which phone you take. So it's a de minimis amount that Apple will definitely be willing to take on to continue to meet demand. So as they're willing to pay more, somebody who has smaller margins, let's say $3 margins, it may be a little bit harder for them to keep up with Apple and pay that extra dollar because now they're giving up a third of their profit margins. And in reality, the question of free economics and Milton Friedman is, should that company be around if their margins are only $2 or $3 per piece? And in that case, a lot of these companies should go out of business and we would have a much more efficient market where you don't have basically everybody fighting for that last dollar and causing a deflationary situation, which has been the plague of the world and in the US in particularly for the last 10 years, or I'm sorry, 8 years since the recession. So now the positive is for America, you bring back, you increase wages go up organically, not because Congress said you have to pay them more. Because that if Congress, it's kind of, you have to look at it as fighting a problem. So if you fight a problem and you say it, okay, we're going to raise minimum wage, then corporations will just figure out how to send more jobs overseas because the difference between what they pay in America and they pay in Mexico and China becomes greater. So it makes more sense for them and now gives them a better incentive to send more jobs overseas. If you do it organically by bringing back jobs and companies not being able to fill the manufacturing needs and the demand for their product, then they will organically raise those prices to make sure that they can fill the demand. Then once you have that, then Congress can come in and raise minimum wage if they want to, because anyways, we're getting paid, the majority of the manufacturing base is now getting paid higher than minimum wage. So it's kind of the way, that's the difference between the left and the right. It's how you look at the problem. The left believes that the government should install certain fallbacks, and the Republicans and the right believe that you should organically increase stuff like minimum wage.
So let me ask you, Gary, out of the major things, the major campaign reforms that he had, Donald Trump, um, which one of them is, in your opinion, the priority that will dictate where the market is going to move?
I think the market wants corporate taxes done relatively quickly. That's something that you don't have to do anything on, and you could increase earnings per share by 5% easy. So if you cut the corporate tax rate, the effective corporate tax rate by 5%, you've increased earnings by 5%. They don't have to sell more, they don't have to buy more, they don't have to change any part of their business. They do it, it happens automatically. End of the year, they make 5% more.
What
So
what
if you look,
about what about okay, so you cut corporate tax rates, but what about balancing the deficit? Does the market care about that?
the market doesn't care about that right now at all. Interest rates are low. The market will only care about that if you get a spike in interest rate, like you saw in Greece or some of the other uh, credit countries, Italy, so on, Spain. That would affect it. But as long as people are willing to buy U.S. credit cheaply, well, expensively, but at cheap rates, the market doesn't care. The market doesn't care about deficits because the market's not looking out 10, 15 years at what necessarily is best for the world economy and the U.S. economy. The market cares how are we going to get corporate earnings up in 6 months, 1 year, 2 years, and corporate debt is not a problem right now on the horizon. That a lot of people saying it's a bubble, eventually it'll pop, but it's not really a problem. I think the 10-year bounced because they're expecting a little bit more. Well, 10-year went down. The 10-year yields bounced because they're expecting a little bit more inflation. But you're still, I believe, at 2.5% on a 10-year, which is historically really low. So the market's not really concerned. Maybe if we get above 3, 3.5, 4%, and we don't see earnings growth that the market expects, we stay in the 2% range, but the yields get that high, then the market will start concentrating on that because that means that it'll be more expensive to pay off the debt for the US government, which means they'll probably have to start cutting back on certain spending, which will obviously lower the growth rate, the GDP of the country. So for now, the market doesn't care so much about deficits. They care more about infrastructure, the corporate tax reforms, and repatriation of money. I think their priority is the tax rate because, like I said, that's something they don't even, that corporations don't have to do anything. They just get a pure 5%, 10% bump in the earnings per share, which makes market go higher, obviously.
And you're
Secondarily,
saying that's already priced in the market right now, or how much of that's priced in?
well, I think I've seen like earnings per share have gone up a bit. They're up to like 123 as some analysts are putting it into their numbers. Other analysts are not putting it into their numbers. At 123, you're probably looking at a 7 to 10% increase in earnings per share over last year, over 2016. But what you're starting to see is that we're trading at a market, as the S&P 500 market, we're seeing that we're trading at 18 times those numbers. So those are optimistic numbers with certain things priced in. You know, some analysts price it in, some analysts don't. It really depends. This is an average of analysts' estimates. So what ends up happening is at 18 times, you're at the historically high end of where earnings should be. Traditionally, over the past few years, earnings have come down because analysts have been over optimistic. So if you see the earnings come down from 123 to even 118, let me do the math real quick here. You're looking at roughly oops, sorry, I made a mistake. Give me 1 second. If you see it come down to around 118, you're trading at 19 plus times earnings. That's a pretty rich multiple when you're only growing the economy at 1.5, 2% on a consistent basis. And you're in an 8-year bull market, which a lot of people are saying are getting long in the tooth. Um, so, it's an expensive market. Is it the most expensive market we've seen? No, obviously the 2000 NASDAQ, but I think we're probably the richest we've been since definitely '08. We might be even richer at this point, depending on where earnings will come in. We might be trading at a higher multiple than we were in 2008, and this might be the highest multiple since that insane P/E ratio expansion of the internet boom of 2000. And obviously, back then the economy was growing at 4 or 5% on a consistent basis. Now we're growing at a 1.5%. Even if you look at 2008, we were growing consistently at 3 to 4%. Now again, we're growing at 1.5 to 2%.
So back to
So you
the
can, yeah.
original question, Gary. So basically, let's say he passes these reform bills through. He manages to cut to lower corporate taxes. There's some repatriation of money, renegotiation of trade. He does everything that he says that he wanted to do, but we're still at historically high earnings per share. The markets at a historically high level. Where do you see us going 6 months, 1 year down the road?
Ooh, it's a really complicated question because we don't know, even if he does pass all these things, we don't know how long it's going to take. So and also what rates he's going to do. So if you could tell me, I mean, I think it's anybody's guess what the corporate tax rate will end up being. Obviously, if he drops it 9%, that'll be a huge boon for earnings. If he's only able to drop it 5%, then it's obviously smaller. If he's only able to drop it 2 or 3%, then it'll have a less of an impact. Infrastructure bill, depending on how big that package will be, over how many years, that will affect how smooth GDP is. Will we see a really big package of shovel-ready projects that are going to have a positive effect in the next year, let's say, that will push GDP to 4%, but then will slow down and go back to the 1.5, 2%? Is it something that's going to pump up GDP by 0.5% because it's a longer term project, but it's going to last for 3, 4 years? So instead of being at 1.5 to 2%, will be 2 to 2.5%, but we're going to stay steady for the next 3 years because it's a steady package. So there's a lot of unknowns, and I think that's why the market has been range bound, is because there's so many unknowns that nobody feels confident enough to really push what they believe in. There's a lot of different potentials, and also even the free trade agreements. How will countries react? Is China going to cut off all American companies to the second largest economy in the world? That would really hurt U.S. companies. If Apple can't sell iPhones in its largest market, that'd be tough. Um, on the other hand, if this causes a severe recession in China, obviously in Mexico, but that's less important. But if it causes a severe recession in China, economically speaking, it's less important, I should say. Um, what ends up happening? How do the Chinese react? Do they just print more money and do a lot of more stimulus, which actually could be positive for world growth? Do they react by allowing some of the stuff to fail? A lot of their banks have really bad loans on the balance sheets that they're just ignoring at this point. It's a socialistic government. They're not as open as we are. They can do a lot of tricks. So the question is, what do they do? Do they get more aggressive as Russia did and start showing its military strength in Asia, affecting some of our allies? Do we come to their backs? I mean, there's a lot going on in the world geopolitically right now that we haven't seen in a long time. Uh, my personal feeling is there's too much debt in the world and it's going to blow up at some point. I'm not saying it's going to happen this year, but at some point we're going to have a recession. There's always recessions. And I believe the next recession will probably be more severe or as severe as 2008 recession. The question is how is it going to be divided around the world? So the last recession, America and Europe felt it harder than China and Asia. If Trump is able to bring back jobs, then this recession will be felt harder in Asia. So the question is where's the severity of the recession or the next recession going to be also? How do countries react? Russia, obviously, when it saw that oil prices were coming to a point where they couldn't sustain $100 a barrel because of the amount of supply that the U.S. companies were putting on the markets, Putin reacted in a very aggressive way, hoping to take internally pressure off of him, as he knew that his GDP would eventually contract. He didn't know exactly when because oil, the supply and demand picture was off unbalanced for a long time. But he knew it was coming to an end. He knew that as long as oil prices stayed higher, U.S. companies would continue to drill and drill more. That would create more supply for the markets. There was no real place where demand was coming onto the market at $100 a barrel. So he was preemptive. He took a preemptive strike. He went into Ukraine. He has 85% backing now because of that, even though the economy is in a recession. Does China play out of that playbook and do something as it sees a recession potentially coming in the near term if jobs start leaving? Do they try to get nationality based on the fact that they need to protect themselves from enemies, imaginary or not? Do they how do they react? And second largest economy, there's a lot of wild cards there. So it's hard to predict. I think the market has done a good job of predicting a lot of the positives and incorporating a lot of the positives into the market at this point. You can't fight that. That's what the market decided to do. It could change at any time, but that's the basis of the market. And I think if we don't get a lot of the positives through in the first week, 2 weeks, 3 weeks of his presidency, if he doesn't talk about it, if he doesn't show that it's a top priority for his agenda, I think the markets will back down a lot. I'm not saying crash here. I'm not saying 10% pullback even. I'm just saying that we'll probably go down, maybe 50% retracement of the move we've had, maybe 100% retracement of the move we had since the election, as the markets kind of reprice and say, okay, well, maybe tax reform is not a 2017 thing, it's a 2018 thing or so on. And I think there's a lot of negative surprises that can affect the markets. Corporate earnings might go down because they're bringing back wages, even though it'll be small. The dollar could continue to gain strength if we do bring back more jobs. Interest rates will go up because people will assume the growth rate. The dollar will strengthen. That's going to hurt a lot of our exporters. So earnings could go down based on that basis. We could see a lot of problems if China cuts us out of their economy. Our corporates, if it makes it less easy or more strict for U.S. companies to sell in China. It's the second largest economy. It's a huge economy for American corporations. So there's a lot of things that could go wrong that the market's not pricing in yet. I'm not going to say those are that will get priced in anytime soon, but it's something to keep an eye on. And as that fear starts creeping in and people start thinking about it, they're going to want to take profits, and bears are going to get a little bit more emboldened, and they'll start pushing it down. And the question is where do bulls feel comfortable buying this on a pullback? Do the bulls, how confident do they feel that we eventually will get corporate tax reform, that we'll get infrastructure package, and so on? So if the bulls feel very confident, they might not be so much lower than bidding for the market so much lower than where we are right now.
Gary, thank you so much for your time. We'll stay tuned, and as always, SizeTrader, subscribe. We'll keep you updated. Until next time, this is Amos with Gary, head trader at